We're going to look today at mortgages. So as part of our study of different areas of finance, we looked at compound interest and simple interest. We're going to look at mortgages today. And I'm going to start by showing a little video clip to you that goes over some of the basic concepts that relate to mortgages.
Buying a house may be the single biggest investment of your life, an investment regularly made possible by a mortgage. But hold on, what exactly is a mortgage?
A mortgage is a loan from a bank or other financial institution that allows someone to purchase a house with a down payment.
To understand how a mortgage works, let's consider Jen and Chris. Jen and Chris have found their dream house, which is selling for $300,000. They have $50,000 to put toward a down payment, $25,000 from their personal savings, $10,000 from their RRSPs, and $15,000 given to them by their parents as a gift.
The outstanding $250,000 is the value of the mortgage required to purchase the house. A mortgage provider will lend Jen and Chris $250,000 in exchange for regular interest and principal payments over an agreed-upon period of time. If they buy their house with less than 20% down, their lender will have them also purchase CMHC insurance. This protects the lender if Jen and Chris were unable to make their payments.
Gradually, home buyers like Jen and Chris build what's called equity in their home by making regular mortgage payments. As they do, lenders will lose more and more of their stake in Jen and Chris's house.
Although all mortgages come with an interest rate attached, home buyers must choose between a fixed or variable mortgage rate. Which you choose will depend on your financial flexibility and your appetite for risk.
A fixed rate commits you to a specified interest rate and a fixed monthly payment schedule. With a fixed rate, you know exactly how much you'll be paying each month and you can budget accordingly. This is one of the reasons why people choose fixed rates.
Selecting a variable rate, on the other hand, means your mortgage payments will fluctuate with the prime rate, also known as prime lending rate, as set by the Bank of Canada. For example, a rate may be listed as prime minus 0.6% or prime plus 0.2%. Though the relationship to prime stays constant, your interest rate will change as prime fluctuates. People opt for variable rates as they are often lower than fixed rates. They do, however, carry more risk. Prime always has the potential to increase.
When selecting a mortgage rate, there is another important variable involved: time. The amortization period is the time a homeowner takes to pay off his entire mortgage. This period can be as long as 35 years. Longer amortization periods allow homeowners to make smaller monthly payments. Keep in mind, however, that the longer a homeowner takes to pay off his mortgage, the more overall interest he'll pay.
A term is shorter than the amortization period and is the amount of time a homebuyer commits to the rules, conditions, and interest rate they have agreed to with their lender. Terms can last anywhere from 6 months to 10 years, with the average term in Canada lasting close to 5 years.
So let's talk a little bit about what you just saw. We heard that a mortgage was a specific kind of loan that was used to buy real estate. So that could be a house, it could just be a land, it could be a farm. Any kind of real estate is what generally mortgages are associated with. So you're borrowing a certain amount that you're paying back in equal payments, and each payment is a combination of interest and principal. Remember, principal is the amount that you borrowed. Interest is the charge that the bank is putting onto that, which is their profit. That's why they're lending you money. And they usually take the house as a guarantee, was they call collateral sometimes, in case the money is not paid back, in case you don't pay your loan. They actually have the right to sell your house to repay the loan. This repayment is done over what is referred to as the amortization period. And that can vary anywhere from 5 to maybe 30 years. And a lot of times people tend to go for 25 years. That's sort of the typical amount that people borrow the money for. No, you generally need to have a down payment when you are buying a home, because no bank that I'm aware of is going to give you all the money you need to buy the home. The down payment is how much you have to come up with on your own, out of your own pocket, usually expressed as some percentage of the purchase price. We're going to use some examples of that to show you what we mean. But the down payment is a requirement that banks have because they want to make sure that you're really committed to that loan, that you're going to make every effort to pay it off. They feel that if they give you all the money for the house, if something goes wrong, you're just going to walk away because you're not going to lose anything. The bank will be the one that takes all the loss. So they like for you to put something in the house so that you feel as if you would stand to lose if you were to walk away from the home. Then we talked about terms. So there's the amortization period. I'm going to break that up into shorter terms. So let's say you borrowed to pay it off in 25 years. You might want to break that up into 5-year terms. Each term represents a period of time that you are linked to a particular institution, which has certain terms and conditions, for instance, the interest rate or prepayment privileges. There are all kinds of different things in the contract, and you are tied for that particular term, but that doesn't cover the whole amortization period. Amortization period usually lasts longer than the term. Banks actually charge you a penalty if you pay off the loan too quickly because they have budgeted for you to pay off that loan within a certain amount of time, and they are going to earn interest for as long as you are paying the loan. And if you pay it off too quickly, then they're not going to earn as much interest from you. So they actually charge a penalty if you pay it off too quickly. The other thing that you heard mentioned is fixed and variable rates. There is obviously an interest rate on the loan. We've talked about interest rates before when it comes to simple and compound interest. And they can either offer you a fixed rate, which means that that rate is going to be the stable known rate for the term of the loan, or it can be variable. And variable rates are based on prime. And what that means is that there is a rate that's usually set by the Bank of Canada or influenced by the Bank of Canada. That rate right now is 2.45%. And banks will say, we're going to charge you that rate plus or minus some number. So what is the bank looking for when they try to decide what interest rate they're going to charge you? Well, they're going to assess what they call your risk. They're looking at things like your credit score, and your credit score, everybody's going to have a credit score at some point. As long as you live in Canada, or in fact, if you live in the United States, many countries have a system where they are monitoring the way you behave financially. So this has to do with whether you're paying your bills on time. Do you have any accounts in arrears? All of this information, and just sort of how many different credit applications are you making. They look at a lot of different things to determine what your credit score is, and it's a number. And the higher the number, the better. And the better that number is the lower your interest rate is going to be. They're looking at your income as well. They're looking at the amount of the down payment that you're making. All these things factor into their assessment of your risk. And from that, they're going to take the prime rate that we just talked about and add on or subtract to it to determine what you're going to pay. Higher risk borrowers are going to be paying more as an interest rate. Another term that you're going to see is the amount financed, and that's really essentially what that mortgage is. So we talked about the mortgage amount before. The amount financed is the same thing as the mortgage amount. It's the amount that you're actually borrowing from the bank. The term refinance will also come up, and refinancing is a practice that people often use when they like to switch their mortgage from one place to another, or just renegotiate the terms of their mortgage. So really what you're doing is you're taking whatever you owe at that point in time and you're paying it off with another mortgage. There's a question that we're going to be looking at in a few minutes that has that part of it as well. There's an aspect of it that has to do with refinancing. Started. Here's the first question. Now, Tobin is buying a house with $300,000 and he's making a down payment of 20% to buy this home. That means that he has to find 20% of the purchase price of the home. The bank is not going to give him the $300,000. They're saying, Tobin, you have to find some of that money on your own. So Tobin needs to calculate what 20% is, and that's what this is. 300,000 times 0.02 or 0.2 rather, and that's equal to $60,000. And that's saying that Tobin has to find $60,000 to pay for this house. The bank will lend him the rest, and that's the mortgage. And to figure out the mortgage, we're just simply going to take the amount that the house is being sold for, and we're going to minus that $60,000. So we're actually borrowing $240,000. That's really what we're borrowing from the bank. That's the mortgage amount. Now, for us to come up with what you're going to pay the bank, we're going to have to get familiar with a particular website. That's the next thing that we're going to do. So for me to do that, I'm going to show you a mortgage summary that comes from a website that I'm going to show you on the next slide. I'm going to put the URL or the link for the website in the description below of this video, and I also sent it out in an announcement earlier on. So let's get to what the website looks like. This is the amount that you're going to be paying per month, and you can see that in the mortgage summary here. But let's look at the So here's what the website looks like when you first get to it. You put in the mortgage amount here, so I'll put in maybe $400,000, and we'll put that in for, let's say, 3%, and amortize that over, let's say, 15 years, and maybe the term would be 7 years. I'll just use that as an example. You press your calculate button at that point, and here is what your screen looks like. How much interest will Tobin have paid when he finishes repaying the mortgage in 25 years? Now look at the mortgage summary again. Same mortgage summary that I had on the previous page. Somewhere on here, it tells you how much interest he's paid. Now, read that through for yourself. I'll highlight where the amount is in a minute. It says over the 25-year amortization period, you will, and it has a lot of stuff here. So focus for a minute right here, because that is where it says you've paid this amount in principal over the 25 years. Well, that's what you borrowed. That's why you're going to pay that back. But you paid this amount in interest, and therefore that is why that represents the answer to the question, the 22660.77. That is the amount of interest that you paid over the 25 years. I'm not interested in just the 5 years, which is down below. It says over the 5 years you will, etc., etc. I'm looking at the part above that says over the 25 years you'll pay so and so. And that's why that number there represents the amount that I'm looking for to answer the question of how much interest will Tobin have paid when he finishes repaying the mortgage in 25 years. How much less interest will he have paid if he paid it off in 20 years rather than 25 years? So you go back to that calculator and change the amortization period to 20 years, and here's what your summary is going to look like. This is a different summary based on me changing one thing from what I had before. Now the question is asking how much less interest. Well, I remember that I was paying a certain amount of interest from the previous screen. So if you went back to the previous screen, you would see what that amount of interest was. Hopefully you remember what it was. Now this page is showing you a different set of information based on a 20-year amortization. So where would I find how much interest you're paying now? Well, it's in the same place. It's right here. But what I'm asking in this question is how much less interest than before. So I'm comparing interest I was paying before to interest I'm paying now. So really what I should be doing is I should subtract those two figures from each other. The amount I had on the previous page and the amount that I'm paying now to give me the interest that I'm actually saving. This is how much less interest I'm paying. The $50,000 here is really how much I'm saving, if you think about it. How much less interest will it be for 15 years? Well, I'm going to do the same thing again. I'm going to go ahead, go to that calculator, the website I told you about, change amortization period to 15 years, and here's what my summary looks like. So here's a 15-year. So here's what my interest is. I'm going to highlight that again. Here's the amount of interest I'm going to be paying over the 15 years. And I'm going to do the same thing I just did a few minutes ago. I'm going to subtract those two numbers, the original interest, this interest, and what you're seeing is that I'm actually saving $97,000 worth of interest. Remember, you have to pay back the $240,000. So that's why the mortgage summary says you've paid $240,000. This principal amount of $122, which is highlighted or underlined, that's how much the bank is keeping out of what you paid. That's their profit. So it's less profit when you shrink the number of years from 25 down to 15. You're saving $97,000 worth of interest. So you might be asking yourself, wouldn't that be the best thing to do? Just go ahead and pay it over 15 years rather than 25? Yes, but also notice that the monthly payment, if you look under the part that says the payment is $2,015.72. That's a lot more than you were paying before. So the question is, do you want to pay more per month but save the interest, or do you want to pay less per month but pay a lot more interest? That's a decision that you're going to have to make in a couple of years yourself. The quicker you pay it off is the less interest that you pay. Let's move on. Question 2. The Johnsons are buying a home for $350,000, need a 20% down payment, and they opted for a 25-year mortgage at 5%. Again, we're going to need the calculator. So what I'm going to do is I'm going to first of all figure out how much they need to finance. Remember, they're not financing the total cost of the house. They're not going to get the $350,000. They're only going to get really 80% because they need to find 20% themselves. So let's go ahead and find out what that 20% is. That's $70,000. Then take that $70,000 away from the $350,000, and that leaves them with $280,000. This is the amount that's being financed. That's the amount the bank is saying they're willing to lend you. So that answers that question. Second question is about the monthly payment is. So I'm going to have to go back to that website, put the information in, and here's what that summary looks like. The 25-year amortization, that's how long we're going to be paying it off for. That would be a $280,000 principal. Look at the interest that you're paying. Hopefully you can see what I'm pointing to here. But also, well, maybe you can't see what I'm pointing to. This is the interest that they're paying. But the figure that we really need is this figure right here, because that's the amount that it says is the monthly payment. I'm paying that amount each month. So it means that to answer the question of the monthly payment is the $1,628.49. That's the answer to the question, what the monthly payment is. What is the amount that they need to refinance at the end of 5 years? Remember, refinancing means go to another bank and ask them to pay off what you owe after 5 years. So look at this thing again, the mortgage summary. This is the mortgage summary, which shows you the amount that you're paying per month. You see that under the 25-year amortization period. But it also shows under that how much you're paying over the 5 years. So over the 5 years, you're paying this much back to principal and this much in interest. Notice that the interest is actually more than the principal. So it means that the bank is keeping all of this money, and you've only paid this amount back to your principal. So if I take this $32,000 away from the $280,000, it gives me this amount of money that you see at the bottom, the balance of $247,821. That is really the answer to the question, because the question is asking how much I need to refinance. How much do I still owe the bank? And that amount is the $247,821. This is what I still have to refinance, because I haven't finished paying for this yet. I've only been 5 years in. It's a 25-year loan, but I've only been paying for 5 years, so I still owe this amount of money right here. Okay, so what's the total interest paid after 5 years? Well, let me look at the summary again. The summary is basically outlining all of that information. After 5 years, if you look at it, let me show you. It says over the 5 years, I've paid this amount in principal, this amount of interest. There's your interest amount right there. So that represents the answer to the question. The 65,530.66 is the amount of interest that you paid over the 5 years. And then they're now saying interest rates are going to go up to 7.5%. That can happen sometimes after you've been in one term and you go into a second term and your interest rate has now either gone up or gone down. In this case, interest rate has gone up. So now you're at 7.5% and you want to put this onto a new loan and pay it off over 20 years. Now remember, what you are paying is on what you still owe. So what you still owe is not the original $280,000. It's now based on this figure here. This $247,000 is what you still owe, and that is what your new mortgage is going to be. And you're paying this over 20 years. So that means that this will now tell you what your new monthly payment is. And that's this figure right here, the $1,979.10. And that represents your new payment. And that takes care of today's class. $1,979.10 is my final answer.